You made $340 in 45 minutes. Without leaving your couch. Without a boss. Without anyone telling you what to do. That feeling, that specific, electric feeling, is the most dangerous thing that will ever happen to your financial life. Because that win didn't teach you how to trade. It taught your brain something far more powerful, that this is possible. That you could be one of the people who figures it out. And that belief is exactly what the data says will cost you everything. Somewhere between 72% and 97% of retail day traders lose money. Not most of the time. Over the long run. The range depends on the study, the market, and the time period examined. But every study points in the same direction. In 2019, researchers Fernando Chague, Rodrigo De-Losso, and Bruno Giovannetti published a paper called Day Trading for a Living. They tracked every single individual who entered the Brazilian futures market between 2013 and 2015. Not a sample. Everyone. 19,646 people who attempted to make money day trading. Of the people who persisted for more than 300 days, who stuck with it long enough to actually get good, 97% of them lost money. 3% made a profit. And of those 3%, fewer than half made more than a Brazilian bank teller earns in a year. Read that again. Of the people committed enough to trade every day for almost a year, almost none of them made a living from it. And yet, in the United States alone, millions of people try every single year. Why? The answer isn't stupidity. The people who day trade aren't unintelligent. Many of them are educated. Some of them are engineers, doctors, accountants, people who are analytically rigorous in their professional lives. The answer is something more fundamental than intelligence. It's how your brain is built. In 2002, Daniel Kahneman won the Nobel Prize in Economics for work he had spent decades developing with his late partner Amos Tversky. The core finding is called loss aversion. Psychologically, losses feel approximately twice as painful as equivalent gains feel good. Losing $500 doesn't feel like the opposite of gaining $500. It feels like losing $1,000. This asymmetry, hardwired into human cognition, is catastrophic in a trading environment. Because it means that when a position is down, your brain screams at you to hold it, to wait for it to come back, to avoid locking in the loss. And when a position is up, that same brain nudges you to take the profit quickly, before it disappears. The result is a pattern that researchers Brad Barber and Terence Odean documented in a landmark 2000 study called Trading is Hazardous to Your Wealth. They analyzed the trading records of 66,465 households over a 6-year period. Their finding, the more frequently someone traded, the worse their returns. The most active traders underperformed the least active traders by 6.5 percentage points per year. Not because the frequent traders were picking worse stocks in isolation, but because of the act of trading itself. Think about what happens every time you place a trade. You pay a spread, the gap between the price at which someone will sell you a stock and the price at which someone will buy it from you. You may pay transaction fees. And if you make a profit and hold for less than a year, you pay short-term capital gains tax, taxed at your ordinary income rate, not the lower long-term rate. None of those costs are dramatic on any single trade. But they compound. Every transaction. Every single day. Now add the opponent you're trading against. When you buy a stock, someone sells it to you. That someone isn't another retail investor making gut decisions at home. In most cases, it's a market maker, a professional institution running algorithms that execute trades in microseconds, that see order flow before you do, that have spent billions of dollars building systems specifically designed to extract small, reliable profits from price movements. They have lower costs, faster execution, more information. And they do this all day, every day. You are playing poker against someone who can see the other player's cards. And you are paying for the privilege. This is not a metaphor. In 2014, author Michael Lewis published Flash Boys, documenting how high-frequency trading firms had co-located their servers inside stock exchanges, physically placing their computers as close to the exchange's matching engine as possible, to shave microseconds off their execution time. That fraction of a second is worth billions of dollars annually in aggregate trading advantage. When you click buy on your brokerage app, the trade that gets executed has already been seen, analyzed, and potentially front-run by systems you will never compete with. And yet, people keep going. Here is where the psychology gets darker. Your brain doesn't learn from consistent failure the way it learns from consistent reward. It learns from intermittent reward. The variable reinforcement schedule, the same psychological mechanism that makes slot machines addictive, is exactly what makes day trading so hard to stop. If you lost every single trade, you would quit. You would have to. The signal would be unambiguous. But you don't lose every trade. You win some. Sometimes you win big. And those wins don't just feel good, they feel like evidence. Evidence that you're learning. Evidence that you're getting better. Evidence that the next trade will be different. Researchers call this the illusion of skill. Nassim Nicholas Taleb, in his book Fooled by Randomness, documents how short-term trading results are dominated by luck, not skill, and how human brains are spectacularly bad at distinguishing luck from ability, especially when the outcome is in our favor. A doctor who has a bad outcome examines what went wrong. A trader who has a bad outcome often concludes the market was irrational. A trader who has a good outcome concludes they were right. The same event, the market moving, gets interpreted differently depending on whether you made money or lost money. And over hundreds of trades, that selective interpretation builds a story of emerging competence that the underlying data does not support. There is also something called the sunk cost effect. The more time and money you have put into trading, the harder it becomes to stop. Not because your odds of success have improved, but because quitting now means admitting that the past losses were real. That they're not coming back. That the version of yourself who was going to figure this out, that version doesn't exist. That is a psychologically devastating thing to accept. And so you don't. You place another trade. This is why the research shows that persistence in day trading is not correlated with improving results. In the Brazilian study, the longer people traded, the more data they had, and still, 97% lost. More experience did not produce better outcomes. Because the source of the failure was never lack of knowledge. It was the structure of the game itself. There is one more number worth sitting with. Fidelity conducted an internal analysis of its own brokerage accounts. They wanted to know which accounts had performed best over a long period of time. The findings were surprising enough that they've been widely reported ever since. The best-performing accounts fell into two categories: accounts belonging to people who were dead, and accounts belonging to people who had forgotten they had them. The investors who did nothing, who couldn't trade, either because they were deceased or simply absent, outperformed the investors who were actively managing their money. Not because doing nothing is some secret genius strategy, but because doing nothing avoids all the costs and behavioral errors that actively erode returns. No spreads. No short-term taxes. No panic selling. No chasing momentum. No buying high because the stock was on a list somewhere. The market, historically, goes up. Not every year. Not every decade with the same trajectory. But over long enough time periods, the broad market has rewarded patient capital with returns that outpaced inflation, outpaced savings accounts, and outpaced the vast majority of active strategies. The average annual return of the S&P 500 over the last 30 years has been approximately 10%. Not every year, some years it dropped 30%, 40%, or more. But the annualized average, including those crashes, is roughly 10%. The average day trader, after costs, fees, and behavioral errors, earns significantly less than that, or loses money outright. The gap between what the market returns and what active traders actually capture was documented in the Dalbar QAIB annual report, which has tracked this divergence every year since 1994. In nearly every measured period, the average equity investor has underperformed the S&P 500 index. Not by a little. By 2, 3, sometimes 4 percentage points per year. Over 30 years, that gap is the difference between financial freedom and regret. So why do people keep going? Because the alternative feels wrong. Because patience doesn't look like skill. Because sitting in an index fund and contributing every month doesn't have the same narrative pull as reading a chart at midnight and feeling like you've spotted something the market missed. Because we are not wired for boring. And the market knows it. You might have made $340 in 45 minutes once. Maybe more than once. That story is real. What's also real is the Brazilian study. The Barber and Odean research. The Dalbar report. The fidelity accounts. The microsecond trading algorithms. The full picture isn't that trading is impossible for everyone, everywhere, always. A very small number of professionals, with institutional access, sophisticated risk management, and decades of edge, do extract consistent returns from active trading. You are not them. And the difference isn't effort. It's the structure of the game they're playing versus the one you're playing. The question isn't whether you could get better. It's whether getting better is even accessible from where you're starting, and what the cost of finding out will be. You made $340 in 45 minutes. That was real. Now do the math on everything else.